Right. So you are welcome to the last but one major topic on the performance management or management accounting sessions. Now, this one we're going to look at short-term decision making. Short-term decision making. Now, in talking about short-term decision making, there are four major topics under it we are going to be looking at. So we have the cost volume profit analysis, which we call CVP, cost volume profit analysis, which we usually call the CVP analysis. Then we have planning with limiting factors. Planning with limiting factors. Then we have pricing. Pricing techniques. Then we have relevant cost. Relevant cost. All right. So these are the four major areas. But quickly, let's start with the CVP analysis. Cost, volume, profit analysis. Now, the focus is actually on profit. And profit is about whether you can reduce costs, increase your volume. Basically, that is what it is. So studying the relationship between your cost and your volume and the impact it has on profit is what we term as the CVP analysis. All right. So basically, that is that. All right. So we're going to take our time to look at the whole concept of CVP, come up with our formulas, and also know how to deal with it in a single state and in a multi-state. But before I go on, there are certain things that you must know, because first of all, we have explained that a CVP is actually a marginal costing thing. All right. So the idea is that the truth is that if we have costs, and we've studied that the cost, we have variable costs and we have fixed costs, right? Whether production or non-production, these are costs. All right. If your volumes go high, what will happen to your cost, your variable cost? Technically, your variable cost will also go high. And we've learned that fixed cost usually is what? Fixed, regardless of the volume. All right. So when we are looking at the cost and the volume relationship and how it impacts profit, our focus is on variable cost. So we will be talking more of contribution. All right. More of contribution. It is just an analysis that we are doing of how, if there is any change in, let's say, the fixed cost, any change in, let's say, the variable cost, how will it impact on our profit? So it is kind of a scenario tool, a sensitivity tool. We call it the what if analysis. What if analysis. All right, what if analysis, because it is a managerial analysis that we are trying to do. So it's kind of that's why it is found in management accounting. All right. But before I move on, let's learn some assumptions, because everything plays under an assumption. Let's go with some assumptions of CVP. All right. The first one you must understand is that costs are categorized into fixed costs and variable costs. All right. Costs are categorized into fixed costs, variable costs. Number two, the sales price. The sales price variable cost. So this is sales price per unit. Variable cost per unit. And total fixed cost all remain constant within a range of activity. All right. Within a range of activity. And we are saying that, so at a point in time, the selling price is known. At a point in time, the variable cost is known. At a point in time, the fixed cost is also known. All right. So number 3 is that the production volume, what an entity produces, production volume, is equal to the sales volume. What does that mean? It means there is no inventory changes. So it means there is nothing like closing stock, no inventory changes. Basically, that is that. All right. And the product mix, what you are producing, the mix of the product, what we learned in advanced variances. So the product mix also remains constant. But the thing is that in reality, do they remain constant? So we are looking at these things remaining constant, even in a multi-product situation. In a multi-product situation. All right. So basically, that is that. These are the assumptions that we are going to operate with. All right. Then let's do a little bit of so from this, we can deduce the limitations of CVP from this assumption. You will definitely have the limitations, because the truth is that it looks as if everything is constant, everything is constant, everything is constant. So the limitation is that this thing is too overly simplistic. It's too simple, right? Because we are assuming that the relationship here are constant in there, but in reality they are not. They are not. Now, when we say they remain constant in the range of activity, the question therefore becomes, what is the specific range of activity? All right. What is the real specific range of activity? Because the truth is that people's behavior changes. So that is that. It is very difficult to determine this because behavior what changes. Behavior is not constant. So determining the relevance range is actually a problem. All right. So that is that. Then you also see that in CVP we'll be doing multi product and single product. The truth is that for multi-product firms, determining a sales mix that is constant or a product mix that is constant is also a limitation. All right. So basically, that is that. And the last thing of these variables remaining static. Variables don't remain static. All right. So these are the limitations that you can do. So variables are not static. They are not static. All right. Then there is a problem in multi-production situation whereby you are going to say that these things are going to stay constant. No, this makes things complex. So there is complexity in reality. All right. But here we are saying that things are constant and all those things. They never remain constant. So you can use the assumption to battle the other way around. Then you have what we call the limitation. But of course, regardless of its limitation, it has some uses. And the first use that we are going to start learning about, we will use the CVP analysis to determine the point of survival of a business. And that is what we mean by the break-even point. So we will use that to determine break-even point. All right. And again, we will use it to determine the risk level of a sales plan. Risk level of a sales plan. How much do we have to sell? All right, so that we can stay relevant, we can be safe. We call that margin of safety. So it is used to determine margin of safety. And we just made mention of the fact that under the short-term analysis, we are learning how to plan within limitation. So CVP analysis will help us to allocate resources, all right, in order of priority. And that is something we have actually gone through in the when we were doing throughput. All right, so this we call planning with limiting factor, the concept of constraints when there are constraints. All right, so that is that. Okay, and this lastly, we use this CVP analysis to do scenario analysis. I told you that it is a what if concept. Okay, so we use it to learn what if this changes. All right, so we use this one to simulate effect of different scenarios that can happen about an entity. All right, so basically that is that. Now we're going to look at CVP in the concept of a single product environment. All right, whereby only one product is done. Then we will look at a CVP analysis when multi-production is also what done. All right, so now let's go into the real deal of the mathematics. All right, so CVP, single product environment. Single product. All right, so the break-even point is something we need to deal with. Now, the break-even point is just the point in the activity level where revenue is equal to cost so that there is no profit. So in this scenario, we will be looking at the break-even point. All right, so and in everything that we will do, we'll be looking at the break-even point in money terms and in what do we call it, in unit terms. So formula one, we have the break-even point. And we are looking at it in units. Don't forget, we told you that this is a marginal costing system. Break-even point is going to be given by the fixed cost, all right, divided by contribution per unit. Contribution per unit, all right, not cost per unit, but what? Contribution per unit. So if you want me to open it up, you can write fixed cost over contribution per unit. All right. Now, what is the break-even? We said that break-even is a situation whereby you are having the revenue equating your cost. So your total revenue is equal to what? Your total cost. So therefore, there is no profit. All right. So you pick up your fixed cost and you divide it by the contribution. And this is in units. So if you want break-even in value, break-even in value, then it is going to be the fixed cost divided by contribution margin ratio. Contribution, and I will explain these things. Contribution margin ratio. Now we've done how to do marginal costing and absorption costing. So when we say contribution, what do we mean by contribution? All right, and when we say contribution margin, what do we mean by contribution margin? All right, so you need to get the understanding of these things. Now, contribution. Contribution. What is contribution? Contribution is simply your selling price per unit. So you need the selling price per unit All right. Then you take away the variable costs per unit. And under marginal costing, we learned that. So that is contribution. All right. So this is contribution. All right. So basically, that is that. Now, if you now want the relationship between contribution and margin, when we look at margin, margin is a profit element. So so basically, you have to understand when you talk of the margin, you realize that margin is about what you have put on your cost to actually get a profit. What you put on cost to get a profit. Therefore, the contribution margin ratio will now be your contribution, which you've seen how to obtain that, divided by, so contribution per unit, all right, divided by what? The selling price per unit. So that is how you get your contribution. So the fixed cost is constant and you have them already in place. All right. So that is how you do break even. The first formula that you need. Okay. Then we come to 2. Here we are going to look at the target profit. The target profit in terms of the level of activity that is required to generate a specific profit. All right. So we are going to look at the target profit that we want to generate. How much should we sell so that we can meet a specific target profit? How much or what quantity or what level of activity? Don't forget the level of activity in here, we are talking about the same thing as what you produce is what you sell. So the level of activity, the level of production that we need to do to be actually meet a certain required profit. All right. So that is that. Now, what is the formula for that? It is, so we have target volume or the level of activity required to meet a specific level of target. So here we are looking at units. So you can also call it the level of activity required to generate a target volume or a target sales, okay, in units. So this one will be given by the fixed cost, so what we already know, all right, divided by contribution per unit. But because there is a concept of target in there, the fixed cost here, you'll be doing target profit. What how much should we sell to be able to get to this target profits? You just use what you've done, all right? And in sales to the same thing, right? So here, if you want the answer in revenue, in money terms, then it is going to be your fixed cost plus the target profit all over. What do you do now? Because it is in money terms, like you saw here, contribution margin ratio. So I'm going to write a CM ratio, all right? So CM ratio. All right. So basically, that is that. Then the last one is the margin of safety. Margin of safety. Now, what is margin of safety? In fact, we are using margin of safety. Margin of safety is actually a financial ratio, and it is used to measure the difference between the company's sales revenue and its break-even point. So the difference between the company's sales revenue and its break-even point, that is what we refer to a margin of safety. It's about the risk level of the sales plan. All right. So how much should you sell so that you will not be making losses? All right. Losses. Now, if you look at, therefore, if you are going to look at margin of safety, we are talking about the sales revenue. and that of the break-even. So in terms of sales, in terms of units, so margin of safety in units, we are therefore going to be looking at the sales, budgeted sales. All right, minus the budgeted break-even in terms of sales. Okay, so units, then break-even in terms of units. And that is how we can find our margin of safety in units. All right. Now, we can also decide to do these things in value. Okay, we do it in value. Now, you must understand that, like I said, this is an accounting ratio. All right, it's actually an accounting ratio. And because it's an accounting ratio, it is a ratio. And so we must run these things in terms of changes. All right. So what we would do is that, so you have your budgeted sales in the unit. So budgeted sales, and please, all these things that we are talking about, in terms of the examiner giving it to you as budgeted sales, he can give it to you as what? Total sales. Be careful. Even these ones, total fixed cost, all right, all those things. All right, for all that you see, total fixed cost, minus the break-even. So we are dealing with units here. So the formula, the same thing, units. And you divide everything again here by the budgeted sales. Just to find the multiply by what? 100%. Now, you see, it means that it tells you the level you need to get so that you don't enter into a loss zone. All right. So the greater the answer, the better. The greater, the better. All right. So basically, that is that. Now, if you want this same ratio in so this is the margin of safety in units. In terms of percentage change wise, all right, this is what we've done. Okay, so in value change in terms of percentage, what do you think it will be? Yes, the same figures that you have here, but we are going to use the sales revenue. The sales revenue, because that is your total sales, all right? The sales revenues that you have minus the break-even point in value. Break-even point in value divided by your sales value, sales revenue, or your total sale or budgeted sales, the same thing. Then you multiply it by 100%. So, ladies and gentlemen, this is as easy as these things are in just a single environment. So, what we need to do is to pull up some questions and start rehearsing. Okay. All right. So, let's go through this together. CVP is actually a very simple thing. So, we have a selling price, we have variable cost, and we also have fixed cost. And clearly, if you want to now find your contribution per unit, I'm not going to write much on the board. So this is selling price, this is variable cost. You can find your contribution. So your contribution gives you what? 5. And so if you need to calculate break-even point in units, for example, do you remember the formula for break-even point? So we said that BEP in units will be given by the total fixed cost or fixed cost divided by what? Contribution per unit. And you have it. The fixed cost is there, contribution is there. Fixed cost is 50,000. Contribution per unit, you found it here to be 5. So clearly, you understand why this 10,000 is there, right? Okay, so that is that. Let me make sure you see, you see everything. All right, so that is that. Now, B, it says that the level of activity that is required to meet the target profit. All right. And in these cases, the examiner should give you the target profit. The examiner should give you the target profit. So assuming that the target profit is what you have here to be 40,000, then you can slot it in. All right. So basically that is that. So if you are giving the target profit, you just put it in and go ahead and do it. Your margin of safety, we talked about margin of safety between what is between, if you remember the formula of margin of safety is the budgeted sales or your total sales, all right, minus the break-even in units. Okay, so we did the break-even is here, 10,000 units. So margin of safety will become your total budgeted sales. Okay, so the budgeted sales that you need. And here you have to be given the number of units that we are talking about. So the examiner will have to give you the units so that you can get your, your total sales from there. All right. So basically that is that. All right. So you see here, giving 13,000. You see, it is not fully reflecting in the question, but giving 13,000, if you take off this, you have 3,000. All right. So basically, that is that. All right. That's it. In terms of sales, you get the figure. So let me give you a typical question where we have all this information. All right. So when we do the multi-stage, because here, all I need to do is that probably I had, so let me say, if target profit is 40,000 Ghana cedis, 40,000 Ghana cedis, then the B, so let me copy this here. $40,000 Ghana cedis. Then it means that you can put these things in and get your figure. All right. So basically that is that. Then when you come to the margin of safety, the budgeted sales in units must be given to you, how much you want to sell in terms of units. So if in units, so the same thing, because you don't really see the requirements of the question. So with budgeted sales of 13,000 units, you will have margin of safety as this, all right? And you continue to do the margin of safety in terms of revenue and in the percentages, all right? So that is that. You have your contribution sales margin because your selling price is there, the contribution is here, all right? So basically, that is that. It's easy, all right? So now let's go into the multi-stage, the multi-products. Then we will look at some past questions. Then we have dealt with the first part of short-term decision making. Very simple, right? So let's look at multi-product break-even analysis. Multi-product. So here we are looking at a situation whereby there is not only one product that is done. Because in the single product, you saw that it is just one product, but businesses don't normally produce just one product. So we have varying product. That is where the mixes come in, all right? So that you know, if I sell more of this and sell less of that, what is it going to be, all right? So here, what you see is that we are going to tweak it a little with some form of adjustment, all right? So now, what will happen is that the first assumption that you have to have in mind, what we are going to be dealing with, is number one, the sales mix assumption. The sales mix assumption. The sales mix assumption. So for a multi-product, this analysis that we are going to do will be determined by the sales mix. I mean, the proportion of each product in the total sales. So, for example, you have product A, B, and C, and you see that product A will be like, let's say, 20%, product B, let's say 30%, product C, 50%. So a mix of the product, all right? That is what you will have, all right? So that is that. And number two, we are going to be operating on average revenue on cost basis. Average revenue and cost basis. So we are going to be running averages. Average revenues and cost. We are going to be running on averages, all right, because it is not one product. One product, the average is itself, all right. So here we're going to run it on the averages. So for revenues, we'll be looking at the averages. For all the variable costs, we'll be looking at the averages. And the averages are based on the sales mixes. These mixes. All right. So basically, that is that. So that is it. So now, for example, if we are doing our break-even in revenue, so what is the break-even point in revenue in city? What did we learn? We learned that it is the fixed cost, i.e. the total fixed cost, divided by what? You remember? Divided by contribution sales or contribution margin ratio. So that thing we learned here. All right. So where are you? Where are you? Yeah. So contributions margin, or you can also call it what? Contribution what? Sales ratio. All right. Because it's contribution divided by sales, if you remember. So here, instead of going straight to contribution sales ratio, so we had this contribution sales ratio. It will now be averages, all right? So you weight the averages on each of the product. This is not an average you do 2 plus 4 over, because these are two figures. You do something like 6 over 2 and get 3. No, we are using what? Averages, weighted averages based on the mixes. So here will be a weighted average what? Contribution sales ratio. And how do we find this weighted average contribution sales ratio or contribution margin ratio, whichever name that you want to use? So weighted average contribution margin or contribution sales ratio will be given by the total contribution. Total contribution. All right. So the total contribution for each product herein for all products. So from all mixes. Divided by the total revenue from the mixes. So basically, that is that. All right. Then you get that. Meaning that if I want my target profit in the multiple products, target profits for the multiple product, because you are doing multi-environment, what is it going to be? Fixed cost, your total fixed cost plus your target profit, like we learned. All right, which usually we will divide it by the CS ratio. Here will be what? weighted average CS ratio. So basically, that is that. So we're going to take an example, and we will use that example to actually deal with everything that we try to talk about here. All right. So let's go into the example. Okay. So we see multi-product here. Okay, we've learned all these assumptions. We've learned this. So let's look at this illustration. All right. So we have a company that is producing product X and product Y. Fixed overheads is 200,000 every year. And it says that the following budgeted information is available for the both product next year. So you have sales for product X and Y, variable cost. Then you have been given the contribution per unit, obviously. Even if you were not given, you could have done that. Then we have the budgeted sales and you have your target profit. All right. You know that now everything that we're going to do, we'll be needing the average. So it is wise to do your average. So the figures that you are going to get should be on average. So what is your weighted average CS ratio? Now, if in fact the CS ratio without the weighted average, what is that? It's your contribution, is that not it? Divided by the selling price, is that not it? So as simple as that. All right. So you're going to do the same. Now here you have 20,000 units for HCS ratio. The contribution is 20 all over. That is the deal. All over. But if you want it per unit, you really don't need to because here will also be 20,000 and the selling price for this particular one is 50. So this cancels themselves. So you could, if they are the same, you could stick to the 50, the 20 and the 50. But we are doing more of an average sort of. So plus C is weighting. Okay, so you do product Y2 to 8. All right, product Y2 to 8. So for product Y, we are looking at 10,000 of it. Okay, that is its contribution. That's contribution per unit. So this is the number of units. So we have the contribution here is 15. And what do you know? The sales for that one will be 10,000 units multiplied by a selling price of what? 60. So here you go. Here you go. Now, if you do this, I'm getting 34.38%. So you have your ratio down. All right. So now, if I ask you to now calculate something like your break even in revenue and the targeted one, because the target here is 300,000. It's as simple. What are we going to do? So let's look at break even in revenue in cities. Remember, it is the total fixed cost, all right, divided by this contribution sales ratio that you have done. So the total fixed cost in the question was given at 200,000 here, and over my contribution, so that would be 0.3438. All right. If you do that, this gives me around 581,809. Let's take it like this. All right. What about the target? So the target is simple. All we have to do is to add the target to this one. The The target is 300,000. So this one will be 500,000 all over 0.3438. And the target one puts me in millions. That is 1.454545. Okay. All right. So as simple as that. As simple as that. Remember, there is the concept of margin of safety. All right, margin of safety, and it is the same thing that you do here. All right, so apart from the tweaks that we've done on these two, the others are the same thing. All right, so basically that is that. All right, so a little few steps. Let's look at this, the margin of safety. We've gone through this. All right, okay, so to do the margin of safety, you have some few steps to follow. All right, because these are various sales revenue is not one, is that we have various products here. So you calculate the contribution per unit, can do that, per mix. All right, that's your next step. You're going to use an example to actually go through that. All right, then we have you doing the contribution or calculating the break-even point in terms of the mixes and the break-even point in terms of the product, the break-even point in revenue and all those things. Then you do your margin of safety. Just to better do this, these are the information you need for us to go through the steps. So we have matter that is producing these products, two types of sports and balls for children and balls in batches. So he produced sports equipment item for children and the footballs also in batches. All right, and a miniature ratchets. Now the batch of the ball sells at 8, and the variable cost is this. So let's situate the information well. So we know that there is balls. He sells balls in batches. All right. And we have the ratchets. Okay. So we have per unit, the amount per unit. So this is amount per batch. And we are told that the balls, the selling price, the batch per batch is 8 cedis. Then the variable cost also per batch is 5. Then we are also told that for the ratchet, it sells for 4, and the variable cost is 2.6. All right. So that is the information that we have. You can do your contribution from here. So contribution per batch clearly is 3, right? Here will be 1.4. Is that not it? So that is what you have. The question goes on to say that so once we said that step 1, calculate your contribution per unit, that is what we have done. So this one is actually from this information, you've done your step 1. Step 2 was to calculate the contribution per mix. All right, contribution per mix. So how do you do contribution per mix? Contribution per mix. Now it says that for every 2 batches of balls sold, 1 ratchet is sold. For every 2 batches of balls, 1 ratchet is sold. And the fixed cost is 407,000 for the period. Budgeted revenue for the next period is 1.250. All right. So basically that is that. So now, what do you do from this one? So that tells you that it says that the ratio of balls to the ratchet is such that for every 2 of balls sold, there will be what? 1 ratchet. Basically, that is that. So for every 2, there is 1 ratchet. So it tells you that in terms of contribution per mix will be 3/2, all right? Then you have this one to be 1.4/1. So basically, that is that. So that is the weighing contribution. Here will give me 6, and here will give me 1.4. So the contribution as per the mixes is like 7.4. All right, so 7.40. That is how you find your contribution per mix. What is the next thing that you do from here? You are asked to, that's you doing margin of safety. So step 3 is to do the break-even point in units in terms of the number of mixes, the break-even point of units. So 3, you are doing the break-even point in units, in terms of the mixes. All right, so that is that. So how much we are looking at the break-even point? You remember your break-even point. Break-even point, if you are doing break-even point, what is the formula? Is the total fixed cost, all right, over what? Contribution per unit. All right, so that is the break-even. But we told you that if you are doing, we will come to the point where you are doing in terms of, we are doing in terms of the product, we are also doing in terms of the mixes. So we will come to how you do it. And remember, we said we use weighted average concept here, right? Don't forget that. So that means that this one, we have our total fixed cost, which was given to us in the question. How much was that? 407,000. And this is for the mixes. So there is a concept of weighted average here. And that is what you have done here. All right. Contribution per mix. All right. So if we want to know the break-even in units, we are using contribution per mix. But don't forget, if it is in revenue, we are using a what do you call it? The ratio in terms of the money. All right. So the break-even point here by 7.40. All right. So this is cities. This is cities. So it is giving us a unit of how much? 55,000 I have here. So that is the unit, 55,000 units. All right. So that tells you that if I'm to go in there to do my step 4, the break-even point in terms of the unit of the products. All right. So this is what's in the mix. All right. So calculate the break-even point in terms of the number of mixes. And this is what we had. All right. So that means that my step 4 is going to be 55,000, sorry, 55,000 mixes of, we have this is the mixes of 2, all right, and any number multiplied by this. So 55 gives me 110, the double of it. Then the second mix multiplied by 1, all right, so that is 55,000. So these are the mixes that are available. So now to calculate the break-even in revenue, do you remember the break-even in revenue here, which will be my step 5? What we did here, what do? You take the units, you multiply it by, all right, the, what do we call it? It's contribution sales ratio. So you multiply it by the contribution that you have, all right, and the sales too is the same value multiplied by the sales. Okay, so basically that is that. So you can go ahead and do that. So what is the break-even in terms of revenue? Break-even in terms of revenue. So break-even in terms of revenue, this is what you have. All right. So that is that. So you can also, since you've done all those things divided by this already, especially the fixed cost that you have here, you've already gone through this, taking your fixed cost and divided by this and divided by that. Your break-even revenue will be simple. So if you follow this process, it makes it simple. So break-even point in revenue. In revenue, don't forget we had to do the fixed cost of this to arrive at this one already. So in revenue, we have two products. So we have balls and we have ratchets. Okay, so in revenue, it is simple. It means that I have 110,000. This one is 55,000. How much do I sell these things for? I think we were giving the sales price for each one of them. This one is 8 per batch, and this one is 4 per batch. So how much do you have? 110 by 8 is 880,000. Then by 4, that is 220. So in total, you have 1,100,000. All right, so that is that. Then lastly, step 6, you can calculate your margin of safety. Now, the margin of safety, you remember the formula is given by break-even sales and minus the break-even point. So, budgeted sales minus break-even sales, break-even point in value. So the budgeted sales, that's your total sales or revenue minus the break-even in value for the mix. Here is 1.1. Here you are giving 1,250. So a difference of 150. So if you were to do this thing as a percentage, you know what you have done. It will be this minus this all over. So it would have been the 150 that we've gotten all over 1,250. All right. And that would have given you like 12%. All right. In terms of the percentages. All right. So, ladies and gentlemen, this is how you go by um, getting the figures done and complete. All right. So, that is that. So, let's take some past questions. All right. Let's take some past questions. You have this one here. Okay. I think the B part is what we are going to focus on. We have 6 mix unit contribution for the brand for brand of motor can compute the weighted average. So these are management accounting questions. All right. So let's look at it quickly and see what we can do. Okay. All right. It says that for cost volume profit to be valid, a number of important assumptions. So the assumptions that we said. So state 4 of them. Then you go. Then let's look at the B parts. All right. So learn the theory as such. All right. So we have the sales prices. So the products are divided into high quality, medium quality, and low quality. So you have high quality, and the cost is here. Commission on sales is also given. So this is the selling price. All right. And it said that in order to record the sales quantity of low quality motor vehicle is twice as compared to that of the medium. What we just did, similar to what we just did. All right. So it means that the low quality here is twice as compared to medium and high. All right. So basically that is that. So it means we will need a mix, and that statement will help us know the mix. So if I says that we should compute the mix, I So we are looking at the sales mix. And from that English, we can know our sales mix. We have high quality, we have medium, and we have what? Low quality. Now, the question says that it's on record that sales quantity of low quality motoken is twice compared to medium and high quality. It's a very simple English. So the low quality is twice. So here is 2. So take note of that. As compared to that of who? That of medium and high. So that is it. So that is what you have. So in terms of percentages, if you are to run this thing by percentages, it means that this one will be like 50%, and this one will be like 25%, 25%. Then you have 100%. So that is that. Then you are told to compute number 2, unit contribution, right? Unit contribution. I hope by now you remember the unit contribution. So we have high, we have low, medium, and low. So you let me just repeat them: high, medium, and low. And you are meant to do unit contribution. And you remember contribution. Contribution is what? Contribution is simply your sales minus variable cost. Then you get your contribution. All right. So basically, that is that. So what is our sales and what is, so are we giving? So this is our selling price is here. This is our cost we've been given, and another cost, commission on sales. They are all costs. So sales, just that we were not giving it in terms of per unit or something. So that is what you have. So the selling prices are, you have 3,400, 2,300, then we have 1,700. All right. Okay. Then what do you have? You have variable costs. The variable cost, they are 2. So here you have 1,200, then another one which is 80. Then here too you have 1,080, another one of 60 is a cost. The more you sell, the more higher the commission. So 690 and 40. So what is the contribution now? So 3,400 minus 1,280. That gives me 2,120. Then, so this is contribution. And like the way we did it per mix, you saw the example that we just did. What was it? So we found the contribution and multiplied it by the mixes, right? You remember. And so here to the mixes. If you want to use the percentage, you can use the percentage. If you want to use this one, you can also use. So if we are using the percentage, this is 0 0.25, 0 0.25, 0 0.50. All right, so this is 2,300 minus 1,420. That is 1,160. All right, 730 minus 1,700. That gives me 970. So multiply by 0.5. All right. So this one will give me 485. And this one will give me 1,160.25, 290, 2,120, multiply by 0.25, 530. So if I want to do the total so that I will be able to do weighing, All right. So what will it be? 530 plus 290. So 530 plus 290 plus 485. That is like 1305. So when I'm doing my weighing, this is what I will do. All right. So compute the weighted average unit cost. So this is it. So weighted average unit contribution, that is III, is basically what I have done. Because the unit contribution for each one is this. And as I have weighed it, that is what I have done. So basically, that is that. So like just like just like the way we did here, when we found a contribution, we multiplied by the weighing. So this is it. That is what we have done. Now we have been asked to calculate the break-even in in volume and in sales. So easy, right? So IV, break-even points, all right, and we are using units first. Is that not it? So what is our fixed cost? So we will need fixed cost, all right, and we will divide it by the weighted average that we have done in units, which is 310,1305. So I have the 1305, so 310 answer is giving me 237.5. I mean, we are dealing in units, so let's make it 238 rounded. All right, so that is that. What about the value? The break-even point in value. The break-even point in value, so we have to do it in proportion, is that not it? All right. So let's see the proportion of medium. Let's see the proportion and everything that we have here. So 238. So this is a break-even point in value. So we split this into high, medium, and low. We know that low is half of that. So half of this is a 109. Then the remaining half is split into two for the boats. That is a 59.5, but it is in units, so we may have to round it. So let's say 60 and 60. Okay, so this is it. So similar thing, go up what we did here. Here. Okay, so basically that is that. So this was the units, and this is it. But we were told that as 2 of 1 is done, like it's 2:1, that kind of thing. All right, so basically that is that. So the same thing we are doing here. So this one is percentages where you have to do 0.5 by that and 0.25 by this. All right, so by these figures. So basically that is that. Now that we have this, we have to multiply it. These are the units, units, and units. So we have to multiply it by the selling. The selling here is 3,400. The selling here is 2,300. The selling here is 1,700. So you get the figures, then you get your break even in value. All right, so basically that is that. So how much is this one? 60 by 3,400. That is 204. Then this one is 138. Then this one is 202, 300. So the total sales here is giving me 544, 300. So that is the break even in value, like the way we did the other one. All right. So the last one, it says that there is a targeted uh, profit, planned profit. Okay. So we are supposed to, how much, and you remember the formula, that will be total fixed cost plus that target or planned profit, all divided by weighted average contribution uh, sales ratio. All right. And you have done this one already. This is it, weighted average. All right. So what you do is that you have your total cost, which is 310,000. Planned profit is also given. Planned profit is 15,000, 1035. So what do I have? 310 plus 15 divided by, so is what? 310,000 plus 15,000, all divided by 1305. So I have 249.0. So, but I will limit it here. All right. So that is that. Okay. So basically, this is it. All right. So how many motorcades should be sold? We are looking at this. All right. So basically, that is it. This is how you go about it. Okay. So there is another one here, which you can take time and look at. So you have the fixed rent charge, variable rent charge, and all those things. Okay. So basically, that is that. You have a feel of it. If you have this manual, you can go in there and do more examples of that. All right. That is it. So these ones too are there. This also management accounting, May 2019, and you have been asked to also May 2019 management accounting. You have been asked to also do all these things. Okay, so pick a pick and go through it, because these ones are very, very simple. These ones are into options. Okay, so for example, if you look at this one, you have been given Boisiako Limited. These are the information, and you can see your fixed here. So this one should be underlined then. Okay, so that you have the total. This is also separated. You have this. So you have all the variable cost, and this is fixed cost. All right. So take note. It is the fixed that should be out. And it says that the budget have provided the assumption that sales will be 800,000 of biscuits. I think this is just one product, right? However, due to economic changes, forecast is now 720. It is expected that the selling price per unit, direct cost, blah, 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 will not change. Of course, that's what we learned within the level of activity. It is also expected that fixed overhead will be the same as those budgeted. And you have option 1, option 2, option 3. Okay. But currently there is a situation you have And this is the current situation of you producing this. All right. So if you are to do this one, it's the same ideologies, but you just have to understand that you are doing this thing in separation. So if you check the requirements of the question, it says A, calculate the expected profit for the current year forecast sales. The current year forecast sales, you have this information, right? So it says that calculate the expected profit for the current year. You know how to go about this? It's simple. So we are looking at the very A part of this question and what you have been asked. So all you are going to do is to calculate the expected profit for the forecast. So let's do that one quickly. Then we will come back to do our normal break-even activity. So we say based on calculate break-even here, calculate this, calculate margin of safety in percentage terms, then sales volume required to meet that particular level of profit. All right. So let's do the first one. Then we come back to do the second one. And that's it. All right. Quickly. Okay. So we have sales. Okay. So we are told that the budget was prepared for 800, and due to this is the current situation. So these figures are for 800. So it means that per unit, we are looking at 720 units. All right. So what is my sales in value? So sales in value, the per unit, we are going to flex it. So let's flex. So for example, this was done for 800, but we are doing 720. So we will do 600 divided by 6 million divided by the 800. That gives me 7.5. So that is it. 7.5. But I am doing 720. So multiply by 720. That gives me 5,400 or 5.4. All right. So that is that. Then I'll less my variable cost. The variable cost, I have direct materials, direct labor, variable overheads, so that I will get contribution. Then I'll come to less this cost. Then I'll get my profit. So this is what you are doing. So this one to 2080 under 800. What's the price? 2.6. So this one is 2.6, but we are doing this quantity by 720. So it's like flexing. All right. So this is a 1872. Okay. Direct labor to 1160 when it was 800. That's 1.45. Flexing it with 720. That is 1044. All right. Overheads 840 at 80. That was 10.5. Okay, 10.5. Flexing it for varying it with 720. That is giving me a very huge figure. I hope I punched it right. So it wasn't 80 then. It was 840, 800. It's 1.05 by 720,000. That is 756,000. So contribution will be how much? So I have 5,400 minus 1872 minus 1044 minus 756. That gives me 1728. Then fixed cost doesn't change. That is 972. 600. So what is profit? Minus 972.6. Profit is 755,400. So this is what you do, and you get 2 marks for that. It's flexing, right? 2 marks. All right. So now let's go to the next ones that we need to do in terms of what we learned. So we've been asked to now do the, what do we call it? The first one is break-even point in units. That's the first one. And so what we're going to do is that the formula is clear. It's total fixed cost divided by contribution per unit. That is clear. With the fixed cost, you see, it didn't change. It was 972,600. Then we now need to get contribution per unit and divide it by it. Now, if you check what we have from this, I think you should be able to get your contribution. So it is 1728 for the entire thing, but we are producing 720,000. Okay, so contribution will be, so this is what we had for contribution. So if you divide it by 720,000 units, that is giving me 2.4. So it tells you that my answer here, which is 972,600 divided by answer, that is giving me units of 405,250 units. That is it. And how many marks is that worth? Oh, okay, there are 3. So it means when you do it, then you get your 3 marks. Okay. So the next thing for us to do is to do margin of safety in terms of calculation, percentage. Margin of safety, you need the sales minus the budgeted sales break-even point in terms of sales value. All right. Then you divide it by the budgeted sales again. So we are doing the margin of safety in percentage terms. So we have the unit here. So the unit was 720, right? That is the selling unit minus the break-even point in unit, which is what we have done, all over back to this 720. And these things are 100%. So what will you get? It's giving me like 43.7%. So here we go. Then that's it. The last one is the required profit. Oh, that one is easy because you know your total fixed cost already. All right. And you also know your contribution. And this is not like different products that you are doing. It's just one product. So what you have here is your total fixed cost, which is, was it 972,600? Yes. And you are adding 144,000. Okay. Divided by what? Contribution sales. Contribution sales ratio. What was our contribution per unit, which is 2.4, right? And the sales ratio will be what? In terms of the sales ratio, so if let's say 2.4, the sales was 5.4. So 5.40 and 720 per unit. That is 7.5. 7.5. So it would have been something like this. All right. So 2.4 over 7.5. That is 0.32. So I can, here is 0.32. So I can come straight, sorry, 0.32. I can come straight and put it here. 0.32. Okay. So basically that is that. And this, that is requiring me the sales revenue. I will get an amount of this plus this, all divided by 0.32. That is giving me 7,539,375. All right, rounded. Okay, so basically this is it. That's all. That's all. All right. Now there is a B part of the question, which was this is C, this is A, this is B, this is C. Evaluate the profitability of the three options. So it's C part of the question. That's 7 marks. So let's learn how to do that. Under the options, right? So under the options, you are asked to calculate the profitability. And you know how we do profitability is contribution minus fixed cost. So under the three options, so let's try quickly to end this video. So option 1, option 2, option 3. The three options. Currently, we have done it and we had this one without any option. This is it. So you are going to do the same thing. All right. The same thing. So we had our sales. Okay. Now, what is option 1 saying? Option 1, decrease sales price by 20%. It is anticipated that this would increase the sales volume by 25%. Interesting. This is pure mathematics. So it is saying that increase the selling price by 20%. And once you increase the selling price by 20%, your volume is also going to increase by 25%. But what was the selling price? Selling price was this, right? But what we've done, selling price is this. Okay. And it is saying that this selling price will go up. So it means that we have to shoot it up. Then when we shoot it up, we have to also increase the, what do we call it? The variable, so sales volume, the quantity by 20%. So now let's work that one out. Okay, so before I come to the sales, meaning that my selling price, which used to be 7.5, is going to go up. So let's do 1.2 by 7.5. That means that my selling price is going to go 9. And volume, the volume is 720, right? And if volume is 720, and I'm going to increase the volume by 25%, so 1.25. That is also 900. So that is it. So it means my unit is going to go up by 900, and my selling price is also going to go up by that. What do you call it? 7.5 to 9. Basically, that is that. So it means that if I am selling, this will now be my sales. I'm selling this thing. So that is 8100,000. So these are the figures. These are the figures. All right. But the variable cost too is going to increase, because the variable cost that were there, what was the variable cost? So all these variable costs are going to also increase. So if I put my variable cost together, it is also going to increase. Basically, that is that. It's also going to increase. My sales was 720 and I've increased this. So this one So basically, it's trying to say 5,400 was increased by 1.2. Is that 1.2? Selling price. Basically, that is that. So these ones two are going to increase. So it means that I need to combine my variable cost and also increase it. So all variable cost is just that volume by, this one is sales. So it's not about variable cost. It says that selling price increased by 20%. It's anticipated that this will increase sales volume by 25%. All right. So it means that the volume that I have, which is a 900,000 now, I'll multiply this by this by this, and this by this. That is what will happen. All right. So let's try that. So the 2.6 by 900 alone, that gives me 2340. 1.45 900. 1305. 1.05 900. 945. Total 4590. Now let's do some mathematics here. If I pick this one now, which is 2.6 plus 1.45 plus 1.05, or that gives me 4 point blah blah blah, multiply by 900. Now just want to see if it will give me this figure. It is giving me something different. Is either I punch it wrongly. Yeah, 900. Now it's the same. So I combined everything here. I had 5.1. Total variable cost is 5.1. Then I multiply it by 900. I also had the same 4590 because, yeah, I wanted to do that to do, quick proco. So that one to give you the same thing. All right, so that is that. Now the selling price, which was this figure. All right, that one there is straightforward. I think it's very, very straightforward. It's straightforward. Which was increased by 20%. So the selling price went up because this is what we had before. If you divide it by per unit, it should give you this 7.5. So basically that is that. Hey, it's a decrease rather, right? Whoa, what have we done? So let's check it. If it is to decrease, it will be 0.8 multiplied by 7.5, right? That is 6. So actually this side is 6. Wow, so let me correct this. So we've seen the total of our variable cost. So this one will go 6. And then what is 6 by the new unit of 900? That's 5.4. And here, what I had before, let me go back, it was the total is 5490. All right, so I can get my contribution. So 5400 minus 4590. Contribution is 810. So that is it for this option. And the fixed cost remains the same. Fixed cost never changed. That was fixed cost was what? Fixed cost doesn't change. Just 97 point something. 90 972,600. This is a loss. To give me a loss. So profit loss. So 810 minus 972.6. That gives me a loss of 162,600. That is it for the first one. These things are just pure English and mathematics. Option 2, decrease all variable cost by 10%. I saw that the variable cost was 5.1 in total. So if I'm going to decrease it by 10%, it's 5.1 multiplied by 0.9. That is 4.95. That is now the new price, 4.95. So the variable cost will be 4.95. All right. So here variable cost is 4.95. 4.59, sorry. And what else? And decrease fixed cost also by 10%. We will do that. This is not anticipated. This is not expected to have any impact on the sales level. But that means that we'll keep our original. The original that we had before was 5.4. Not this one, no. The original that we had here before. This one. Okay. So then this one will reduce. And we are keeping 720 units, right? That gives me, so 3,304, 800. So that is 720 units by what has been reduced here. All right, so that is that. And minus 5,400. I'm having 209, 5,200. Fixed cost would decrease. So the fixed cost that I see here, 972,600. I'll multiply it by 0.9. Decrease by 10%. So if you do, this is 875,340. This is interesting. It's a matter of just understanding English and using it. So if I do 209,200 minus answer, I have 1,219,860. All right. Looks as if this is huge. So between option 1 and 2, I would have gone for option 2. But let's look at the last one. Decrease all variable cost by 10%. No. Decrease selling price by 10%. Decrease fixed cost by 5%. The expected sale increase. This is expected to increase sales volume by 25%. But we already done sales volume that has increased by 25%. Oh, and that one was 900 units. So that is that. So this part we've done. But the selling price is supposed to decrease by 10%. The selling price is 7.5. You decrease it by 10% means multiply by 0.9. That is 6.75. So 6.75. So 6.75 and the unit is 900. That is giving me 6,075,000. And variable cost didn't change. So I'll come back and put the variable cost that I had here before. 4,590. That is the 5.1 multiplied by 900 units that we did here before. So answer minus 4,590. That gives me 1,485. Then I've been asked to reduce fixed cost by 5%. So that's 0.95 multiplied by 972,600, right? That is 923. Sometimes 970. Some of these questions, it's just a matter of English that you are manipulating. 1,485,000. What I'm having here is 561,030. So I think this option is better. All right. So option 2, you go for. You say you write option 2, accept option 2. And how many marks is that? 7 marks. Yeah, so that is that. So ladies and gentlemen, these are the things you must go through. There are so many examples in my man accounting book. All right, so a similar one to is here. Just shine your eye, break them down. These are the option 2, that kind of thing. Okay, so the same thing, they repeated it. What we did, this is 2021, and it is coming from something we've learned how to do from which date is the one that we just did now? May 2019. So that is what you'll be doing, and just apply the English to it, do the options, and you'll be fine. All right. So, ladies and gentlemen, this is it. The next time we meet in part 2 of short-term decision making will be how to learn about planning with limiting factor. All right. So see you there and have a great day. Bye-bye.